interest rate, this interest rate. Why we don't use a different interest rate for each different cash flow pricing? That's probably accurate. But why not? Okay. All right. This is difficult. Okay, go ahead. Carl, you say?
When we calculate it, so we project the future value. So we calculate the future value of the bond, including the coupon payments. But at the point when we are projecting it, we don't know what the future rate will be. So we use the present one just because.
Right, close, not that close. Okay, let's say you're gonna get it $1 million cash 30 years later. You should get a present value, use this interest rate, or use this interest rate. You should use that interest rate, right? Yes. You get money from here, you should this interest rate, right? So what our coupon payment in each period of time? Why we don't use each period of interest rate? In the real world, they do use computer, they do this rate, but we didn't use a flat, right? So we use one interest rate, just a flat line. Just we use this one interest rate, we just use this one. That's it, flat one. And then use this interest discount all the coupon payment. So here's the case, okay? The interest rate would we use I in our formula. That interest rate is the yield to maturity, okay? Remember we said, what's the yield to maturity? Yield to maturity, that's how we got it. In the real world, you cannot yield to maturity, okay? You cannot observe it. Yield to maturity is not observed, it's calculated. How we calculate it? We base on remember our definition is we base on each coupon, okay? And then pricing we saw the price of this bond. Let me go back to the chart, okay? Okay, that's the yield to maturity definition. So this I actually is yield to maturity of the bond. So we define what's the yield to maturity. How we got this I is we base on the price. What's the market trading this price? We know the coupon and the face value. Those are all known information. Okay, and the price is market given, trading that any moment changes. So this yield I also changes too. So this all constant because it's called yield to maturity. We calculate it from the price. Okay, that's how we got this yield to maturity. But you cannot observe from the market. It is calibrated out. In the real world, how we get the price, how trader know this price trading right. You have to first get a price, and then we get a yield to maturity, right? The trader is really based on this price, this coupon, cash flow. If it's 1 year later, they use a 1 year interest rate of that bond. This one is 2 years, this 3. They have to identify exactly match of that level interest rate. Like 10 years interest rate compared to the day everything includes 0 interest rate. It's not fair, right? So you have to be identified they each at what time get what cash flow. That's called reinvestment risk. So that means you have to take care of interest rate. Now we use same one. This same one is calibrated from price. It's not wrong, just from the price. Okay, so that's why we can assuming we use this price. Assuming this, remember they said assuming you hold it to mature means all the cash flow you have it, not default, and then you calibrate this yield, and this yield called yield to maturity. All right, so that's why we said we last moment to talk about this definition yield to maturity, because this is difficult. Okay, here yield to maturity. All right, so now you know the difference, but should it be different? Different cash flow have different interest rate. Okay, so that's what we figure out. Let me repeat it again. Okay, so all this interest rate should be different in the real world, and then get this bond price. But however, we get a yield is based on the bond price and calibrate out this yield to maturity. So they all identical, assuming hold to mature, all the cash flow we got it. The bond don't default, then what this yield level is. But once we do that assumption, all the bonds do the same assumption, then we can compare yield to maturity. Okay, so now we go to this level. Okay, So we understand what I mean year to maturity now. You know that all the flat one line, okay, for all the maturity, and that one calibrated from bond price, so that's accurate, can reflect assuming bond holding to mature and each level of the yield, each different bond have different level. Okay, let's see this one. So yield to maturity on a 10% coupon rate. Remember this character, just a 10% coupon treasury bond, and that's this bond character, just like how tall you are, and this is how big of the coupon. Okay, that's it. And see, then you forever with this bond. So never change it. But interest rate change all the times. But the bond the coupon, once they issue, they stay there. Okay. So 10% coupon bond mature 10 years. So that's this bond character, 10-year maturity and 10% coupon bond, okay? Face value 1,000. Okay, watching, very important here, okay? So see, look, the yield to maturity on a 10% coupon bond in 10 years, face value, and this is bond price, okay? Look, bond price. And then what happened? Look at the yield to mature, that's I in our formula. Okay, so watch the trend. When those I increased, okay, in our formula, the yield to maturity, that the interest rate, that's also called interest rate, okay, it's bond interest rate. It is yield to mature. So if they increased, what happened to bond price?
It decreases.
Decrease. Very, very important. Okay, so number one important thing is the bond price and the yield to maturity always have inverse relationship. Okay, so yield to maturity increase, the bond price will going down. If yield to maturity going down, and bond price will going up. See, all right. Now one more thing. This coupon bond, 10% coupon rate, okay? So coupon payment. So that means 10% multiplied 1,000 is $100. So you always get $100 each period, okay? So if 10% coupon bond, if the yield to maturity moving to 10, moving to 10%. So that means if yield to maturity equal to coupon rate, what's the bond price?
1,000.
Yes, equal to par, equal to 1,000. So that's always true. You don't believe it, you can always to calculate it by always 1,000 is par. So that means as long as yield moving around, moving to equal to coupon rate, the bond will be selling at a par. Okay, so from this list, at least you know this couple features. One is interest rates versus the bond price, always inverse relationship. Okay, this is calculator showing you, but we can look at formula, right? Look at the interest rate all year to maturity. They all in denominator. Okay, all in denominator, but top denominator all constant. We know this is fixed. This is fixed. All the C is the coupon payment. That's why I call fixed income, right? They all fix it, and the fixed value always 1,000. So fix it. So all the fixed number. But then denominator is the interest rate, it's the floating ones, keep changing in the market. So if this keep changing, then bond price will change it. We know now. But if we look at this relationship, interest rate and the price, see interest rate in a denominator, that means if all the I increased, bond price will be what? Decrease. Yes, lower, decrease. Always. So formula showing you also invert relationship. Okay, always invert relationship. Okay. So formula also prove that. Numerical calculation also prove that. So that's the relationship we know. And the one is the interest rate equal to coupon rate. The bond should setting at the par. Okay, so that's what we know. Next one. So we move next level. We understand year to maturity. We know the mortgage payment. Those we calculate already. This is easy one. This is just a perpetuity. Okay, perpetuity formula easy. So perpetuity price equal to the payment divided by this interest rate. Okay, this is if it is coupon payment, then this is the coupon, the interest rate of this pricing of this cash flow. Okay, so that's the price. So this is very simple. nothing you can do. You know the coupon payment, or you know anything cash payment, and then you know the interest rate, and you will be know the price. Let me give you your example. So simple formula, but I just do quickly example. Let's say is you want to donate money to our school, Baruch College, right? You're famous, you make a lot of money, successful already from our school. You say, I want to donate the money each year, $2,000 every year, forever. Okay, but you make a promise this year, 2021. So when you make this promise, how much money you should have it so then you can make this contribution. Let's say interest rate is 1%. Do it for me right now. Say how much money you can do it. If you have it, you can make this commitment about the $2,000 a year, every year, forever. And interest level it is 1%. How much money you need to have it? So you promise this. What happened to everybody? It's so simple. Formulas there, right?
Can you repeat the question?
Okay. If you're donating money to Baruch College, $2,000 a year, forever, and at this moment you make decision how much money you have it now to make this commitment. How much money you need to have it to make this commitment?
$200,000.
Right. Okay. So how we got it? So easy. I know easy because you worry, you're scared. Say, wow, how come? But it's true based on the formula, right? So easy. So how much you need to have it? So you give $2,000 each year and divide by interest rate. That's what the formula say. Just follow formula, right? So equal to what? 400,000, right? You agree?
Yes.
So yeah. So if 200,000, so you will feel doesn't make sense. You know why? Because interest rate. Because interest rate, you may be not ever to protect be always the same level. Imagine if interest is going lower and lower, so you pretty much you cannot handle it. So that's depend on interest rate will move around unless you can hedge this interest rate. But this is perpetuity, all right? Perpetuity very easy, just give you forever, and then all you based on interest level, so divide by interest rate. All right, so that's easy. That's just a perpetuity. Nothing you can say. We don't issue those bond, perpetuity bond, but some other country they did. Okay, just some simple one. All right, so now we do discount bond, right? So remember, discount bond is not discount rate. Discount bond means the bond do not pay coupon. Therefore, they selling at a discount. And therefore, the bond, it is called discount bond. Normally, it's in government treasury bill, normally they're selling discount, okay? So that's called discount bill. So how they make money, you can make money because, like I said last time, I said, if they issue the bond at par, at 1,000, then at the maturity, you get 1,000, nobody will buy your bond. You have to selling at discount. So then at the maturity, you get 1,000, okay? So here's how to calculate it, okay? Let's later on calculate this rate. Let me just give you an example. Okay, let's do the example how you setting it, how you buy or get a return, whatever, regarding discount bond. But normally like this, okay? So bond, let's say this is T-bill, could it be 3 months, could it be 6 months, T-bill, right? It's selling, I just give you, say, part, we all use 1,000 as face value, okay? So selling at 950 right now, okay? But maturity always 1,000. At the maturity, you will get 1,000. But when you buy now, you pay 950, all right? So what's your return then? What's your return? Oh, Or you can tell me how much money you made it.
Is it $50?
$50. Very good. So what about your return though? You know $50, but you want to compare, should I invest in T-bill or something else? So you need to calculate what's the yield to you, means rate of return. Do we know that?
0.5%.
How to do that? Tell people how you did that.
It would just be, well, I would do the difference. So the amount that we,
I think you just divide the 50, which is the return.
50 divided by who?
Nine-
Very good. This is important part, okay?
yeah,
Divide by 950 or divide by 1,000 becoming very, very important issue. You should always divide by the money you take out. You took out the money is 950 and you get 1,000 minus 950. All right, that's what you should get. Okay, 950 is you use your money to generate this return. So that means $50 divided by 950. So what's your return?
5.26%.
Let me see your result.
5%.
5 what?
5.26%.
Yeah.
5.26%. Anybody? You agree?
Yes.
Okay, good. So we agree. That's what you return, okay? So that's what you compare you compare junk bond, compare everything else. Is that, okay, this is actually a good deal. You buy this one. That's what it is, discounted bond. They don't pay you coupon, but it's selling at a discount. But doesn't mean they're not a good deal. You know, sometimes you have to be very careful. This means the yield to you, how much it is given to you, that's return. And you compare others, and then you make the investment decision, okay? And that's what I mean here, okay? So that's discount bond, selling at discount. No, we just did, okay? Face value minus the price you pay and divide by price. Okay, so that's how, this is easy, right? Because discount bond selling at a discount. All right, so we remember we are not a finance course. We are just everything touch a little bit, let you know, then we talk about our key point here. So let's go there, okay? So rate of return. So if you buy, so here they're trying to tell you how you calculate separate way, okay? So if you buy coupon, buy bond, you have coupon. So coupon divide by your price, this is yield, coupon yield, called current yield, right? So the current yield. And this piece, if is price you sell, your price sell, and the price buy. The difference is capital gain and loss, okay? So the capital gain and loss. Then divide by the price you buy. So that's the becoming capital gain in percentage, okay? Or return, only from capital gain return. Then you plus the yield, this is income yield, right? It's coupon. If it's dividend, a dividend yield. So that add together is total rate of return, everything in, all in. If you have income, calculate income yield. You have capital gain or loss, calculate, so total calculate is called rate of return, it's return, okay? So all in. All right, so here try to say is, I just talk to there, okay? So this is why if it's dividend called current yield, you know, so that's what a given name to current, because divide by current at the point time price. Okay, so coupon, let's say is $50, always $50, but the price keep changing, right? So then this one keep changing, so that's current yield. And this piece we call capital gain and loss in percentage, but in another way is it is a growth rate, right? So from PT to PT plus 1 was a percentage change, and that's the gain, right? So that's what the rate of gain. So that's G. We use G that indicated as being growth from previous one. How much percentage growing? It's growth. Okay, so that's trying to tell you this way. So we're okay on this. Or you want to exercise? Let's do exercise. So one more time exercise. Let's say we have how about let's use dividend this time. Okay, we use dividend. Let's say you buy Apple stock in January 1st, right? So then you buy at a price, let's say $100. Okay, $100. Apple stock. Okay, and then you collect dividend equal to $2, just hypothetical, $2, and then you're selling it. So you're selling it after you collect dividend, selling at 115. How about that? 115. Okay, it's selling at 115. So this is a story, and then question is, so what's your return? Or we can just say total return, or just say return. Same thing. It means everything all in. What's your return? So you
17%.
can use that formula, or you can just do it when you can separate. Let me give you a formula, okay? So your return, you can, here they say this anything, okay? We can be typing anything. I can just say return this way, okay? So equal to, you can say anything on the denominator. Let's say we have dividend income, okay? And the plus capital gain, that piece means PT plus 1. Somebody get result, tell me.
What is it? 17%? Maybe?
You got 17%. Let me just choose it.
No, 17. I was just out of the top of my head.
Okay, let me type in this formula first. PT plus 1, and then I did do that way. Okay, PT, right? Divide by PT. All right. So you got the number is what's the percentage?
17%.
17%. You all get 17%. You agree? Okay.
Yes.
Let's verify. Okay. So dividend is $2 plus the price you're selling it is 115. Yeah. Yeah, that's easy. Minus 100. Right. So 70. And then divide by 100. Your price you pay. Okay. So that's how you did. Okay. 17. Now, good. So 17. So what's the percentage you got from the dividend yield? What's the percentage in dividend yield, or what? And then what's the percentage is capital gain or growth? This is so simple. You don't need. There are no formula to input. This is very okay. Can I use calculator? You can use you still have to use calculator just to input one by one. Okay, you just use the calculator. Put the cash flow. I don't know how you're gonna do it. You're gonna use your calculator. Cash flow 1, 2, like that way. Okay, so let me question for you. Which one is dividend yield? Which one? What's the percentage of dividend yield? Means dividend divide by price PT. That's dividend yield, right? And the rest of that's the gross one is gross G. So equal to PT. I just my PT plus 1 not looking good, okay, because that's supposed to be lowercase. I cannot do it. The PT, okay, PT, and divide by PT. All right, so let me. So then the rest of it, even dividend yield, how many percentage? What's the dividend yield? 2%. $2 divided by 100, right? So that's 2%. And then the rest of it is 17% from the capital gain growth. So that's how you separate. That's what the PowerPoint showing you how you separate it to looking at. All right, so here is. So that's what you see. This one, the dividend yield, current yield. So that's what it is, right? So that's dividend but divided by this, and that's this growth. So that's what. Okay, separated. It's the same thing. So you can figure out which one coming from. But it's okay. It's the first one. What did they ask you? Then you break down. Okay, so like I say, that's not the key point. We learned this. The key point is we talk about next level. What's going on? Okay, here is the whole point. Okay, so distinguish between interest rate and the return. Okay, interest return we just calculated, okay, from our investment. What's the investment result? Capital gain or income yield, right? It's just side. You can coupon is current yield or dividend. That's why you just see different one, different income and different yield. But same thing, it is the yield from that cash flow. All right. So interest rate is different thing. Okay, although they all look like percentage, like coupon also percentage, but it's not. interest rate, it is market affect, reflect this company or corporation's quality, a lot of thing information in there, and they movement all the times. Coupon do not movement. Return will change, but return is coming from your investment result. We just calculated. Interest rate is not. Interest is moving around, okay? So we just saw that. So then give you this kind of discard, but when we're looking at the next, you will see, okay? So return equal to year to maturity only if holding the period equal to time to mature. So what it's trying to say is if we invest the bond, hold this bond to maturity, your return will equal to year to mature. Remember, year to mature is that we use it, but we assuming calibrated already with the market price. And assuming you don't have default, you're not seeing cash flow losing. Everything assuming is okay, and then holding to maturity, calibrate the bond price right now, and that's assuming you based on this everything okay. That's why it's a year to maturity, and like here trying to say is if nothing happens, that's equal your return. Okay, so but not always. Okay, not always. That's why you have to interest rate change all the time. So, okay, so rising interest rate, we talk about this, will be price will drop. So a rise in interest rates is associated with a fall in bond price. We saw it, okay? So I don't need to talk about more about this. And always inverse relationship, okay? So those things I mentioned already, just leave there. Key point, I want to talk the examples, okay? So I leave there, more distant bond, we will see next one, we do detail clearly about long-term bond. Distant means long-term, short-term. So what happening to interest rate, okay? Let's see example here. This is very important, okay? So we do little by little analysis, then those words, just what I'm talking here, okay? So this is 1 year return, okay, on different maturity, 10-year coupon rate bonds. So means many bonds, they all same coupon rate, okay? So same coupon rates, but different maturity, okay? But 1 year later, what happened? I mean, I will say that again, okay? So when interest rate rise from 10% to 20%. So here's, let me talk about this, okay? Here's have many bond, different bond, here is, okay? Based on maturity, you have 1 year to maturity, 2 years, all the way to 30 years. So have so many bonds, we have 6 bonds, okay? But they all same coupon bond, means the same coupon, they all 10%, okay, 10%. So initial yield is 10%, right? So coupon rate 10%, initial market interest rate also 10%. Therefore, they all pricing at a par, okay? So ask me a question here, okay? But here they ask you, say, well, the oldest bond there, but they ask you, say, what happened 1 year later? What's this bond? Remember your calculator, okay? Bring up a calculator. I'm going to ask a question very soon. And, but not only 1 year later, but also interest rate changed from 10% increase to 20%, okay? So let me repeat again, this is a story. All those bond, different bond, same coupon rate. Okay, at the beginning, interest rate in the market is 10%. So there are 4 year to maturity and coupons the same. Therefore, they all selling at a par. But 1 year later, this is 30-year bond becoming 20-year bond, right? 1 year passed. This is becoming 19 year. This is becoming 9 year. This become 4 year. So 1 year later, but during this 1 year period movement, interest rate also changed from 10% to 20%. Now we ask you, what's 1 year later, those bond price? You just do one, simple one. I want you to verify how we get this 2-year bond 1 year later, interest rate from 10% go up to 20%, and the bond price is this price. I want you to verify and tell me how you get this number, and then you know what's going on. I give it time, just read these things, and then how you get this number. Remember, that's a 2-year bond, but 1 year later. Anybody, you want to try? Or you say you cannot figure out, or somebody already figured out? Are you okay? Are you working on?
Yeah, could I see
Yeah.
more example, Professor?
No, I want you to struggle a little, then we will do it. I want to see who can try to struggle a little bit to figure out. Anybody? I just want to know, do you working on it?
Yep.
Jim, you get some answer?
Not yet.
Not yet, okay. As long as you tell me how you figure out this 917, that'd be fine. I cannot waiting for forever. Let's see who can try, just have sense, maybe how that works. Okay, let's go together. Let's looking at it together. Okay, how we got the 917? That's the question to ask. The story is a little bit, just a little bit difficult one. Okay, let's see. So if you're, like I say, when you learn, say always draw the chart, something difficult, do little by little, okay? So, okay, we do know this is, we focus on 2-year bond, okay? It's a 2-year bond. So this is 1 year and 2 year, okay? So at the end of 2 year, we know this bond material, the bond should pay you 1,000, okay? So with this we know, okay, that's one thing. And then we also, 1 year passed, so here is, okay, so this today 1 year passed, all right, so 1 year passed is here. Here's the problem, ask you, at here what's the price, what's P equal to? That's what it ask. So you just based on the story, okay, watching what I say. Look, if I ask you price in here 1 year later, so what we have it in the cash flow? So you do have one coupon because it's 2 year maturity. You have coupon here too. And you tell me what's the coupon payment? What's the coupon dollar?
0.
Huh? Why 0? Look at the two year maturity coupon. Remember coupon? What's the coupon? What's the coupon rate?
10%.
10%, right? 10% multiplied by 1,100, right? Okay.
Yeah.
So coupons 100. Then we also have face value before this 2 years bond matured. So this is what we know the cash flow. Okay, good. Then they tell us to say, okay, the interest rate from 10% increased. So then 10% now is 20%. 20%. That's what we know. Put all we know in from 20%. Okay. All question asked about this price, but then you know now. So what's the, did you figure out? So this is price, but you do know interest rate, you do know cash flow, and just one period right now. Because 1 year passed, so one period. So now you know how to get this one. Did you get a 917? Now you know equal to 917, how we got there. Did you get 197 based on this? This is easy now. This don't even need a bond formula, right? Amir, you want to say something?
I just want to know how you got 997.
Oh, you want to know how to get it? Okay.
I got to
Can you go
917.
more
got it?
details?
Yes,
Who got it?
I did.
I couldn't get it.
Go ahead. Show people how we got it. Equal to,
Oh,
tell me how to do it.
It's pretty simple. It's the $1,000
Exactly.
principal plus $100 of cash flow.
Very good. Okay, so 1,000 plus 100, and then what?
Divided by 1.2.
Exactly. Thank you. Okay, we'll talk about the story. Okay, so divide by 1 plus interest rate 0.2. All right, only 1 year left, so that's just 1 power. Okay, so equal to that price. If not equal that part, let me know. You agree? But oh, yes, thank you. Oh, you see, I cannot change it. Okay, I hope I can do that. You see, I can do that. No, I cannot. Let me see, do that. Okay, that's not a, well, you guys know what I'm trying to do there. Okay, so let me do this one more time. So equal to 1,000 plus 100. 100 is coupon, 1,000 is face value, and then divide by the 1 period discount rate, right? So 1 plus 1.02, so it's 1.2. So then you will get a 917. Okay, the key point is the analysis, okay? So whole point is, what did they say? They're trying to tell you, you see nothing changed. Coupon didn't change, coupon rate didn't change, okay? Yield to maturity in the beginning didn't change, but interest rate changed. But now here is, this is coupon, the 2 years maturity bond, 1 year later, okay? Coupon, same thing. Face value still there, but this timing passing. So then you will do that, okay? So then you just 1 period, that will happening to interest going up to 20%. This is easy one. I want to ask you one more time. Okay, let's go the other one, go difficult one. See, now you can figure out. This time you need to use a formula. You cannot do the simple one anymore. You need to calculate. Let me ask you one more question. How about do the last one, 30-year, this one? Okay, so 30-year maturity, that bond, same coupon bond, coupon 10%, but interest going up 20. You need to put input in a calculator, okay? So what did you get? This 503. Now this time you need to put a calculator. So let me ask you a question. When you input, what's your coupon payment in payment when you input?
100.
Right. Okay, 100 is a payment. Very good. What's the interest rate you input?
20%.
Thank you. 20%. Good. What's the period? How long? How many period?
29.
Thank you. Very good. Then that's it. Then face value 1,000. Now you get it. Just based on what Joe very good. Okay. So based on you just input. Okay. 29 is a period, N period, right? N, because 1 year passed, only had 29 years left. So 29 is N. 100 is payment. Interest rate is 20 because already increased from 10% to 20. So 20, and then future value is 1,000, and push the button present value. Did you get a 503?
Yes, 502.
Good, good, very good. Okay, so now our job is not just calculate bond. Okay, our job right now, we know you know how to calculate bond. The job is analysis right now. Okay, so here's the point: the same coupon bond and the different bond maturity. You can see that interest rate from 10% going up 20%. Look, who loses money the most? This is rate of the capital gain. How we get this number? How we get this number? Anybody know?
That's just,
how we calculate capital gain or loss?
So 500 in this case, in the case of 30-year, it's 503 minus 1,000 divided by 1,000.
Right, because 1,000 is your paid, right? So did you get it 49.7, right? So that means you can see 1,000 in the beginning, okay, by the par. So after 1 year later, due to interest going up, they all going down. Who lose the most? Long-term bond or short-term bond? This is long-term bond, right? This is long-term bond, 30-year, 20-year, and then 1 year. Who lose the most?
Long-term.
Long-term bond, yeah, look at this one, almost 50%. And then the first one, why first one untouched? The first one, 1 year bond, look. Exactly, thank you. That's the whole point. That's why you know, look, this bond 1 year later matured, get the coupon 10%, and then that finished. But everything else still alive, so that's why they suffering, right? This one, first one matured because 1 year maturity, that one. Okay, good. So there's here showing you from the capital gain or loss due to interest going up, long-term bond lose the most. Long-term bond down like this one, 30 years versus 2 years. 30 years, almost 50%. Half money is over, right? Loss. Now watching. This is a capital gain piece. Remember, we have total return, have gain, capital gain, and the coupon, right? Gain. So now we have 10% coupon. Remember? So 10% is still gain there. So 2 columns here, you have 10%, and plus you have your loss 49. So net result is 39.7. Okay, this is how you got it, because you have coupon income, that's 10%. Okay, remember I said coupon always come in, no matter what happens, unless the default. Okay, so you can see add up 2 pounds, so then net result it is first bond, 1 year bond get a 10% gain. The rest for the all lost money. Second year that one is okay, make 1.7. So this is showing you when interest going up, long-term bond more risky. Okay, so that's what the word here is showing you. The word all is just talk about what are we doing, and also you recap about how we calculate the bond. Okay, so that means remember this interest going up. Okay, bond price going down. Now right now also showing you long-term bond lose the most. Okay, actually you should be smart enough to know here is if interest rate going down from 10%, that's a drop to 8%. Who make money the most?
Long
The
term.
longer bond.
Yes, thank you. Exactly. So now you know, if you project the future interest rate will going up, you should be selling the long-term bond. If you're bond manager, money manager, you have to manage the bond. You cannot go to say, I'll go to stock market. You have to, then you go to short-term bond, right? That's what they play. The play bond, the short-term one. That's why they say holding short-term duration. We'll talk about duration. Okay, short-term duration means short-term bond in general. Okay, so because you know interest is going up, but imagine couple 10 years ago, interest rate high, and you manage your bond, you just manage, going to go to lower and lower. We all know interest going to lower last 10 years until to today 0. So you should holding long-term bond over those 10 years. So you make a lot of money, right? So that's the whole point is, yes, always inverse relationship. Okay. So now you know your bond price keep changing because interest rate keep moving. All right. That's called interest rate risk. Uncertainty. Risk is uncertainty. All right. Go ahead. You have a question. Go ahead, Ajay.
I got you. Yeah. I'm just confused about how you got the next year price. Like, I mean, I'm not really
Okay.
sure.
Okay. Let's go there. How we get the next price? No, here. You want to say
the last
which
slide,
one?
yeah. Just like any of them, like 917. I'm not sure how you got 917.
Oh, how you get 917? Let's go back there. We did here. Okay. How we get a 917? Okay, so remember the bond material, you will get a face value, okay? And then you have coupon payment 10% multiply 1,000, so always $100 coupon payment. That's what you're going to gain the cash flow at the end of maturity here, right? Interest rate from 10% the first year and jump to 20% at the second year. So they just said from first at the first year beginning is 10% and later on 20%. So they owe 20%. But this one bond by the end of 2 years matured, so they over. So now we know interest rate 20%, cash flows this much, and discount back. So you get you do this one, you get a 917. So you get a 917. Everybody agree, right?
So the one in the 1 plus 0.2 is the year left. The one.
No, this one. This one's wrong. Don't worry about this one. This is just what? This is
the
equal
1.2.
to 9.
So you add the 0.2 to like the how much years is left, like how many years are left?
Just 1 year left, right?
Okay.
This is 1.2. Let me type in this formula again. Okay, so it is 1,000 face value plus 100 is the coupon payment, and divide by 1 plus interest rate is 20%. You only have 1 year left. That's why your power is 1, right?
Okay.
You agree?
Okay.
Let's go to 30 years. Why you do the logic analysis is, yeah, let's do 30 year, okay? It's like this, okay? All the way 30, but the interest is 20. So your input, you use the calculator, right? Your input is N is, first one is just N change different. 30 year bond, okay? So now only 29 left, right? Because 1 year passed. So this is bond, the rest of that, it is 29 period. So N 29 input, okay? Use your calculator. You have to use a calculator right now. Okay, and then payment, PMT is a coupon payment, it's 100, right? And then your interest rate is 2%, so 20%. So put a 20, that's I or Y in your calculator. So I, okay? And then what's the face value? It is 1,000, 1,000, okay? That's it. So then you just push a button, say present value or your bond, and you will get that number. 503. He says 502 something. Did you get this? Everybody? Right. Okay, then the book is running the number. Okay, very good. So 502.5 something. Okay, so that's how you got it. The first one, 2 years, I used because of easy to analysis and easy for you to calculate. So save my time. So for if we understand 2 years, you definitely can understand all other years. Okay. So we got it. It's good. So you stop me. It's good. Otherwise, you get lost there. You're stuck there. Now, what I talking? The important things. So inverse relationship, capital gain. That's all you miss it. But now you know. Once you calculate those bond price, then you just calculate the capital gain. Like it is gain is always right. So what the end price is 503 in this case, and minus beginning price. Then divide by the price you pay. Beginning is 1,000 as a par, because before in the beginning selling the par, that's why yield equal to coupon. So divide by 1,000. So 503 minus 1,000 divide by 1,000, you get negative 49.7. But it's on the capital gain piece. Then you need to add a 10% coupon, so you have 39 loss. So a little bit lower than before on the capital gain. Okay, so like
Professor,
I say, if we're interested, yeah, go ahead.
Could you explain, simply explain the current market fears with raising interest rates?
What you said right now we are.
Yeah.
You saw that our Treasury, U.S. Treasury 30-year yield already going up.
So
yes.
Could you simply explain that?
Yeah, because we are, you see the right now economy right now, we're going to be print the money, right? So that's the problem right now. Macroeconomic point of view right now is that we are supposed to recover, everything's getting better. But however, people worry about we already, this 1 year print money more than last financial crisis, double that money already. So people really worry about out of control, the cash flow, the money. Okay, so Fed also mentioned about the digital dollar, digital. So that's why you see the Bitcoin is trouble right now. Remember, so right now it's so a couple of things that also they worry about the technology bubble could be there. So economy is not even because some of unemployment people really don't have job, and some people really get the money and they get the gambling in the market or something, make trouble. So that's difficult right now. So they have target on what they should recover. They also wanted to full employment. Okay, so but this couple of days is a good thing. Okay, this couple of days, this week is Nasdaq, the technology stock keep going down. The more going down, more better. Okay, everything is going down, we cool down, we don't waiting for a bubble burst. But right now it is a good thing is we go lower, otherwise too much. And so right now waiting for the policy, this 1.9 trillion still haven't approved yet. And then this is not only one, because after this, they're going to have a stimulus. This package is called rescue package. Next one is a stimulus package. And therefore people worry going to be what's going on. So interest rate they worry if interest going up. Remember, we haven't seen inflation yet, but people are worried if it jump too fast, it could be inflation pipe. And then when Fed, last time, same thing, okay? Then when the Fed raised interest rate, immediate market crash. That's what they did. Each time Fed raising interest rates, the market just crashed. So that's why they worry Fed should be careful what they do. If right now put the money in, then interest low, then out of control, then we're going to be overheated economy. They have to fastly raising interest rate. Just looking at the Fed fund rate 2007, before that, you see how fast they raised interest rate to the point crash. So that's the couple of things there. Yeah. All right. So we know this, and interest is going up and down. Let's go to risk. Okay, very good. So you know interest risk, very. Fed fund rate is our target rate. So once that one raise interest, raising it, and that's what the market everything follow, because that's indication, and that's also barometer interest rate means. All interest rate follow from that one. Okay, so interest rate definitely have risk because they're moving around. Nobody can control its market. Okay, depend on the economy, depend on the Fed policy, monetary policy, physical policy, global market. So definitely moving around, you saw interest rate moving, and then your bond price will moving. It also stock market will moving, and also exchange rate moving. Everything follow. So that's why people know interest rate is important. Okay, so you can see from this your bond market how follow that. Okay. Interest rate, when you're talking, we have to talk about nominal interest rate and real interest rate, okay? So this is the easy part, because whatever we mentioned, the interest rate is a nominal interest rate. And then you remove out inflation, and then becoming real interest rate, okay? This is a very simple model, okay? So like, for example, if right now you're looking at your, let's say you look at your T-bill, paid. Well, right now, even 30-year, let's say 30-year Treasury bond, paying you last time I'm showing you is 1.89. I think this couple day going up a little bit. Let's say 1.9%. Remember, this is 30-year Treasury bill only paying you a coupon 1.9%. That's very, very low. So that's why interest rate too low right now. But that said that if interest rate going to 2%, we are not in 2%, just hypothetically 2%. That's the next year go to 2%. Then you coupon, this is 30-year Treasury coupon bond still paying you 1.9%. Basically, you get a negative yield. Who want it? That's why yield right now going up, because yield going up means bond price going down, right? Bond going down means nobody want bond. They dump the bond. They dump the 30-year bond. Nobody want it. That's why price drop. Okay, so that's the logic there. So you imagine if inflation, you tell me going up, and the Fed already mentioned that they all want inflation a little bit more. Plus, they already act. They don't worry about inflation. So therefore, you can see that if pay 1.9 and in the future inflation is 2%, your yield even didn't cover the inflation. So useless. That's why people don't like it. So that's another thing. Okay, so that's what I mean in nominal inflation and real nominal interest rate and real interest rate. Okay, the relationship inside is inflation. So let me give you this here. Okay, this is a Fisher equation. This equation already modified, make life easy. Actually, a little bit a little difficult, complex, but it's okay. Same number, not off too much. So we normally just make a simple analysis like this. So this is a nominal interest rate, and this is real interest rate, and this is inflation expectation. Remember what I just said? Normally, people will already price in what is expectation. So we expected in the future will have 2% inflation, for example. Not happening yet. That's why right now you don't see it, but they expected. That's why it's not, they put it in the expectation. But people act based on what they predict. They predict inflation will going up, therefore the interest rate will going up. Okay, let's say even in real interest rate, nothing changed. Okay, only change is inflation, expectation on inflation. Then interest rate will going up. Interest going up, your bond price is going down. Remember inverse relationship? So therefore, bond market, bond price right now not happy day. So because people know this, already pricing in right now, just say, inflation will be there, and then interest rate will going up, and that's why bond price going down. Okay, so that's what the interest rate is. So you can see this. We saw this chart before, but I repeat again because in here is linked to our knowledge. Okay, so blue line is nominal interest rate. Okay, so the red one is estimated real. Okay, so that means the real interest rate. The difference is inflation. Remember, we know 1995, 90 during that period, very high interest rate, and that moment we also know is inflation high. And that's why I can see the bigger, if you from this point to this point, that's a huge inflation we had during that period. And we said that's linked to the oil crisis, right? So that's actually showing you the relationship, okay? This is last slides. Okay, so we finished chapter 4. Any question here? Any question?
Yes, Professor. After the class, I have a question not related to the material. Once we're done.
Okay, go ahead.
Professor, yes, I have a quick question.
Go ahead.
So when, let's say we're looking at a bond now, or a T-bill or anything like that, and the given interest rate is 20%, for example. Is that 20% the nominal interest rate or the real interest rate?
Yeah. By default, okay, if they say any interest rate, your credit card, anything, all those rate, it is a nominal interest rate.
So the real interest rate is only when we're looking towards the future.
Huh? What do you talk about? Why are real interest looking at the future?
Because
the inflation here. Inflation is your use expectation inflation, because inflation past we know, right? Let's say past the last year we don't have inflation, so you don't make decision based on past. You based on the future. Say, oh, inflation coming, I gotta buy a house now. You should buy a house now. Seriously, I'm not joking, because right now interest rate lowest moment. Buy house the best. Okay. Borrow money from parents, buy something that's real assets, plus interest very low, lock in. In the future, you won't have this low interest rate anymore. Even Warren Buffett years ago even mentioned about that, say, this is never met this low interest rate. After he said that, interest rate even go lower.
Professor, I have a question.
Yeah.
So when we were doing the 30-year interest rate problem before with like 503, was that from the buyer's POV point of view or the seller's point of view?
Either one. And buyer selling, they all pay the price. Only difference is spread, but you just this we don't care about spread. This point. This is the price at the end of 2 years.
So the capital
selling in the market.
The capital gain, is that for the borrower or the
capital gain is if you hold this bond, what do you gain or loss, right? So let's say the bond you buy at the moment beginning is at the par is 1,000, okay? At the end of 1 year, this bond worth right now trading at 503, right? So you based on this is your capital loss because you buy the 1,000 right now you only have 503. So use the 503 minus what you pay and divide by what you pay. You lost 49.7%, but you did get a 10% coupon. So then you lost really total loss is 39.7. Okay. Good question, because it doesn't matter. Doesn't matter you own the bond or you buyer seller. This is just this bond after 1 year what the price is. And if the owner have the bond, you lose the money. But if the buyer want to buy now, actually buy at the low at 503, right? But right now market trading 503. If you buy at 503, it's really good deal because what happened? The other guy buy at 1,000, you buy at 503. How much you can lose, right? Plus you have 10% coupon. So this means if you project the won't be down from 20 to 30, you pretty much feel this is the bottom. means this lowest moment interest can only up to that high, cannot be go to roof. So then you buy at the bottom. So this is a good buy if your analysis is accurate, right? But really, if it could be like we said, go to the, go to like a hyperinflation 1985, and then you go to 50% up from 10%, from 20 to 50, you still can lose more. You have this bond that definitely you lost totally. All right. So you follow me here, right? You needed to do a couple exercise this one and just follow the formula, calculate how to calculate capital gain and loss, and you will be able to figure out. And then you see the direction on a long-term bond based on the fact, the data, and see then lose more. But reverse is true too. If interest going in the other direction, go to lower and lower, and the bond, long-term bond will gain bigger one. Okay. So it means you need to bet on direction. What's interest rate going to do?
So,
but you need to figure. Yeah, go ahead.
So when interest rates are low, do you want to be selling the bond or buying the bond?
If interest is going lower, price is going higher, right? So you should buy now if you project the interest, if you project the price will going up. Do you want to gain? Doesn't matter. Always doesn't matter what. Okay, always buy low, selling high, right? Always doesn't matter. Buy oil, gold, buy stock and bond. Always buy low, selling high. So if you project the bond price will going higher, so buy now, right? So if that means you project interest rate from now to going lower and lower. So the price will going higher and higher because they are inverted relationship always. So then you should buy now, and then later on you're selling at a higher price, and that's how you make money, right? So always follow that logic. Buy low, selling high. Any other question? Actually, I did open the other chapters. You want me to go the chapter, the other one? You want to go to chapter 5? Any question? No question. Now you want me to go to chapter 5? Or you want more practice?
More practice.
More practice.
More practice, which piece? You want, let's do that. Let me give you more example here. Let's see which one you feel you want more. You know what? I do this. What about interest going lower? What? Go ahead. Okay, let's do this one. So this is same 2-year bond. Okay, let me put information here. Remember, this is 10% coupon bond. 10% coupon bond. Okay. Now I say if interest rate down mover. Okay. Down from 10%. We beginning 10%, okay, to 8%. 8%. Now you calculate this long-term bond. So this bond, 2-year bond. So what's the price? Because 1 year later, okay, so now my story here changed. This is not 20, this is becoming 8%. Let me do this. Can we do that? I'll put this here, 8%. So only thing difficult because they have something moving target which is changed. Let me do this one. Okay, good. All right. So can we do it? So 2-year maturity bond, 1 year later, interest changed from 10% to 8%. Now I ask you, what's the bond price? Remember before it's 917. So right now we know we're above par. But what the exact number is?
1018.
1018, let's see whether it's true. Okay, let's do it together. So price equal to, we know the cash flow, 100 is coupon. We have 1 coupon left. We have face value. All right, and then we have 1 plus 0.08, that's interest rate. Okay, 1 period, only 1 year left. So equal to 1, what? Sorry. What's number? 1,000 what?
19.
1,019. Thank you. You
No,
agree?
No, 1019.
1009. Okay. Everybody agree? Let me do it.
1,018.
So nobody
1,018.
verify for me? You agree, right?
Right. Yeah. Yeah.
Okay, good. Okay, very good. So now you will agree. So that's, see, going up, right? When it is going down, price going up. Previous one, it is 917. The bond price sort of selling lower than par. So selling 917. And this one selling higher, and which is above the par. So it's $19 more. That makes sense because interest rate going lower. So now you know the direction, and then you can verify. If you got lower than 1,000, you should ask yourself something wrong, because this bond should be selling above the par because interest is going lower. Because it's selling the par in the beginning is 10%, and then interest is dropped. This is happy news for a bondholder, and price will going up. For long-term bond, even more going up. Give you one more so we have time. Do the 30-year bond, okay? So same thing again for 30-year bond. So 30-year bond, that one only have a 29-year left, okay? But everything else the same, but interest rate only is different. It's right now, interest rate is 8%. So I equal to 8%. So everything else same, and then see what's the bond. You will be very happy have this bond, long-term bond. So 1,223, right? Okay, you agree? So all you need to do this way, okay? So let me put a PV here. Okay. So your input is, let me put here. Input is, we got that, and the payment, the PMT is 100. Okay, 100. And we have a face value or future value, so 1,000. Okay, what else we need to do? That's it. And push the present value button. You will get a 1,223. You can see going up a lot. So that's, if as a percentage, you use 223 divided by 1,000 you pay, you make a what? 22.3% gain, and plus coupon. Go ahead.
Can we calculate the payment, the coupon payment from multiply?
Payment is a coupon payment, right? This payment, the PMT coupon payment. Payment, remember when we tell you coupon, you immediately know 10% of coupon, this 10% is coupon rate, right? And then multiply the face value. That's how you get a payment. Always is a cash payment. Go ahead.
No, I'm asking, let's say I don't know the coupon payment and the coupon rate, but I know the price, I know the face value, and I know the interest rate. Can I calculate?
Oh, you want to figure out a payment?
Yeah, okay.
Okay, so let's do it. Okay, let's change the story. Okay, I'm gonna give you a new story. Okay, so let's say the bond is just a 3-year bond. Okay, so N equal to 3. Okay, and then coupon, we do not know, want to figure out. So you know the bond price, equal to, let's say 980. Okay, you know bond price, you know everything else. So hypothetical interest rate equal to 2%. Okay, so now push a button, you got a payment, same thing. And the face value, everything face value equal to 1,000. All right, okay, we stop it. So anyway, push the button, you will get it. So we have everything, right? We have so question is what's the payment, the PMT? The same thing. So PMT equal to.
Thank you.
Yeah, you're welcome. Just same thing, okay? Just practice left and right, it will be okay. Okay, so have good, so your homework I put right now is material, the due date is May, but I think once we know the midterm, when I make an announcement midterm, I will tell you right after midterm that day, okay? Right now, just open for you for now. And then later on, when we know that's midterm, I will close it right after midterm that day, the homework, okay? So that's it. Okay, good night.
Okay.
Go ahead. A question, just go ahead.
All the homework isn't connect, right?
What's that?
All the homework are in Connect. The homeworks.
All the homework is on the, what do we call that? My Econ Lab.
Econ
My
Lab.
Econ Lab.
Oh,
Not Connect. It's
No, Connect is a finance
Pearson.
one. This is
oh,
my
I have,
Econ.
yeah, I'm taking both classes. I forgot. Yeah.
Oh,
I'm
I
taking both
see.
of the classes.
No. Yeah, this different one. Okay, so the other one, my Econ Lab is for this homework. Connect is a finance one. Yeah, different. Okay. Any other
Professor.
Yeah.
Professor, the homeworks, all the homeworks
ahead.
are due at the end of the semester, or?
I say is we right now temporarily put it in there. We do not know what's the final exam day yet. But for midterm, when we finish the midterm, the next day I will close the first chapters for the midterm chapters. So those one will due after midterm that day. We do not know yet, but I will close right after, because usually it's for you to open by then. So therefore, we're going to close after midterm day.
Oh, okay.
All
Okay.
right. So right now, just assume it's open, but then you can buy anytime. But by the midterm, I will tell you, I will know midterm is which day. Now, when I make an announcement, I will mention about the homework closing day.
Okay.
Okay. Any
Okay,
other
thank you.
question? You're welcome.
Yes, Professor. I have been unable to access my Econ Lab. So whenever I go to Pearson, I can only see my other classes. And when I try to enroll into this economics class, it says that I need the CRS number or any specific ID.
It is on the Blackboard, the ID number. Okay, you just look at the announcement, the ID number, it is on the Blackboard announcement.
Professor.
I don't see it.
Is there a secondary
It is
bond
on the announcement. I think a CME 4330, something like that. Go looking at it, it's there on the Blackboard announcement. Okay, go ahead.
Is there a secondary bond market?
You secondary market, yes. You have primary market, yes, secondary, yes, absolutely.
No, my apologies. That's why. No, I still can't see it. All I see in Blackboard is 3 announcements. Oh, okay.
It's the title. It's the title.
Never mind. I see it. Thank you.
Yeah, you will be able to see. Everybody else see it. Okay.
I got it.
All right. No, any other question? Yeah.
Yep. Got it. Thank you.
Okay. All right. Have a good night, everybody.